Ben Reppond. Welcome to my YouTube broadcast. Today is April 23rd, 2025. So this is the market. So I will explain this, and you probably know this. The market is in deep decline. It is collapsing. What we don't know is how far down it's going to go. Is this the bottom, or is it yet to come? And we just don't know. I think there's probably some more decline, but I don't know how much and I don't know when. But I know this is frustrating investors. And what really frustrates investors is that the advisors don't have a good answer for it. They're not getting, most of them are not getting out of the market. They don't have a shift in their allocation. They just say, stay the course, stay the course. You can't sell now, invest for the long run. And I think it's a terrible answer for people who are trying to find some answers. Okay, so the major indexes, so there are two that are foreign indexes. They are on the top. This is measured by the year-to-date numbers. So when you look at just to the right of center, the year-to-date change is a 7% gain for EFA, which is the developed markets, mostly Europe and Asia, or excuse me, Europe and Japan. And then a slight gain for the emerging markets and a slight gain for long-term government bonds. Everything else is significantly in the negative category. The Dow down 8%, S&P down 10, NASDAQ 100 down 13, and the Russell 2000 small cap fund, IWM, down 15%. To the right of that, the last four columns are these above their moving average, the 20-day moving average, or the 50, the 100, and 200? They're all below all four averages, except for developed markets, EFA. The S&P 500 breaks down into 11 industry sectors, and those are measured from top to bottom. The one on the very top is consumer staples. Consumer staples are things like groceries and soap and things like that. And so things that you need every day. That is above the moving averages, and it is positive for the week and for the year to date. Now, I want to point out, as I've studied past cycles, each time it works differently. Sometimes when the equity market is going down, precious metals will actually be going up, or utilities, or healthcare, or energy. Those will be going up for some period of time, maybe not the entire period, but they will be more positive. This time it's consumer staples. I have seen other markets where consumer staples went down with everything else. So this is not a recipe for staying out of trouble in all markets, but this market, it is positive. Everything else, quite negative. And when you get to the most growth-oriented sectors, retail, consumer discretionary, and technology, those are at the bottom, and they're at the bottom by a lot. So they are down 16%, 17%, and 17%, just on measured year to date. If we took the worst period, that would be probably the beginning around the 1st of February to present. These would be a lot more negative. But I don't have to tell you that the market is not doing well. It's really struggling is a kind word. Collapsing is probably the right word. This is the S&P 500, a 3-year chart, and you can see there's two lines here. The black arrow shows the longer-term trend, which is still up from October of 2022 to present. The red arrow at the far right shows the decline in the past 2.5 months. And so a very sharp downward trend. It tried to go up, and now it's coming back down again. So the question is, we just don't know where it's going. So it could go on back down to where it was on April 7th, that bottom, or it could go even below that. This puts it on a candlestick chart. Same 3-year chart, just done with candlesticks. So when the market is going down, for the week, it starts here and then ends here. That's a red candlestick. When it starts here and goes up, then that is a hollow candlestick. Occasionally, it'll start here, go up, and come back down and settle back about where it started, and you see a few of those. This takes the S&P 500 and puts it on a 2-month daily chart. Now, I've been showing you weekly data, so now I'm going to convert that to daily data, kind of a little more micro, and you can see what's going on with the market in the last 2 months. So definitely some up and down, but I drew a black arrow to say, and this is before today, Monday, and that's going to make another red, probably by the end of today, make another red candlestick going down. So the trend is down. The NASDAQ 100 is compared to, on a relative strength basis, compared to the S&P 500. And when it goes up, that favors the NASDAQ 100. When it goes down, it favors the S&P. And you can see over this that 2.5-year period of time, it has in general gone up from left to right. However, I put the black arrow going back to July of last year. So this is about 9 months-ish, 9 or 10 months, that the direction is actually down. So the trend, it's a shorter term trend, but it's a trend is negative. The SPY-G growth portion of the S&P 500 compared to SPY-V, the value portion of the S&P 500. The S&P has both components. It's got the growth stocks and value stocks in there. You can see from this chart, overall, it has moved from left to right going up, which favors growth over a 2.5-year period of time. But there's a lot of up and down, a lot of this, meaning growth is in favor, then value is in favor. Not very much of a trend, at least on a short-term basis. I put a black arrow to show you the short-term trend for the last couple of months that is basically favoring value. The last week or so, maybe that's 2 weeks, there is a move up that favored growth. But overall, I'd say its value is more in favor. The S&P 500, the 500 largest companies, compared to the Russell 2000 small cap index, the smallest 2,000 companies. So what's in favor, large companies or small companies? And you can see from my black arrow that large companies are more in favor than small companies. A little bit ticked down this past week, but still large companies are in favor. Long-term government bonds, they want to go up, people want them to go up, and they can't go up. Why? Bond yields are going up. Interest rates are going up, or there is the perceived notion that they're going up. And if the perception is they're going up or they're actually going up, that's going to drive bond prices down. I'm talking about quality bonds now, government bonds. And so you can see in 5 years what's happened. They have dropped approximately in half. 50% of their value has evaporated. Now, from a traditional investing portfolio, stocks and bonds typically make up about 40% of that allocation. It could be 50-50, it could be some percentage, but 60-40 is the most common. And if I knew I'm not a buy and hold investor. I'm not a buy and hold investment advisor. But if I knew that that is what I was putting my clients into, and for 5 years, 40% of their portfolio was doing that, I think I'd scratch my head and try to figure out what else I could do, because I don't think it's just not a winning combination. I took it from August of 2024. You can see the last component of what I just showed you. I put it on the candlestick chart, and this is done, one candlestick equals 1 week. So you can see that the direction is down. And again, when I checked today, it's down again. Even though stocks are down, bonds are also down. The dollar is not doing well, and I think this has to do with the tariffs. I'm not a currency expert, but you can see from the beginning of the year, the decline, a pretty sharp decline. It looks like it's on its way down further, but it's been on a pretty good trajectory up, meaning that our dollar goes further when we're buying foreign goods or services, and those who were investing in the U.S., their currency doesn't go as far. Now that's changing. So now with this decline, this makes foreign investment, the U.S. more attractive for foreign investment, and the U.S. dollar being spent abroad doesn't go as far. Okay, the big winner, again, is gold. Gold is, look at that. What a chart. Gold is doing amazing. Now, this is another area where I am not a traditional investment advisor. I like people to own physical gold and or physical silver. Most advisors, and I'm going to say over 90%, that's just an opinion, I hear that a lot, so they don't recommend this. Dave Ramsey hates it. But I think it's the right thing to do, because if the currency we have is just paper currency, if it collapses or continues its long-term, over a century long period of time decline, what is your alternative? What is your antidote to that? I think precious metals have always been a good antidote, and I'm in favor of people taking some of their taxable money. I don't recommend it for IRA, 401k type money, but for taxable money, take some portion of that and buy precious metals and store them in a safe place where you know where they are, but they're extremely hard to find by someone else. And I talk to people about this all the time. So I do recommend that. My personal preference is silver, because I don't look at it as an investment. I look at it as an insurance policy. And if I want an insurance policy against the decline of the dollar or the collapse of the dollar eventually, then I want something I can buy groceries and fuel with, the essentials in life. And I think precious metals do that. But, you know, does it go up? Does it go down? I personally don't care that much. I'm more interested. I've owned my silver for a long time. And but even at today's prices, I think you still, if you need an insurance policy, you need to buy an insurance policy. Silver is more volatile, still going up, still the same trajectory, but more volatility like this. Gold has more of a smoother line to it. So yes, silver is up for the week, the last couple of weeks, so was gold, but you do see more volatility. Bitcoin has been in a decline for most of this year. We have a Bitcoin model. We've been out of the Bitcoin model for a long time. And we're sitting in money market in that strategy. That's a 2.5-year period of time. Volatility, this is, as you can see the spike at the end, this is a weekly chart. So this is kind of end of one week to the end of the next week. The spike at the end goes up to 45. The intraday went up to 60. So if you're maybe intra-week, I should say, went up to 60. So yeah, it went up that high, but on a weekend to weekend basis, 45. And it's back down now to 28, 29. And I put my line there at about 24, where I kind of consider anything above that to be high volatility. With today's decline in the market, it could spike back up into the 30s and 40s. So this is a period that is, the volatility index measures a lot of what's going on right now. Okay, I put this chart on because I like the chart. The U.S. versus, versus South Korea. The U.S. has done very well versus South Korea and is not as volatile as it is with some other countries. However, when you get to the end of it, actually goes back into December a little bit. So for about the last 4 months, South Korea has been outperforming the U.S. stock market. This is EWY compared to SPY. And you see that black arrow, that decline, that shows a 4-month decline in the U.S. market compared to the South Korean market. But prior to that time, obviously, the U.S. market was doing better. Gold and silver. As of last Friday, April 18th, the price per ounce, spot price per ounce was $33.28 of gold for gold. That's a 3.2% increase over the previous week. So you remember you saw that chart where it just keeps going? That's what's going on. Silver, $32.43, 2% increase over the previous week, and a gold-silver ratio of 102.6 to 1. So this favors, gold has done better, but those people who manage their assets, manage the ratio of gold and silver, consider this a good buying opportunity for silver, because they tend to be correlated, but they each come and go in favor and out of favor. I have been, it's my opinion that the banks, the big banks, manipulate the spot price of gold, and the markup on gold and silver is more a function of supply and demand, but not the spot price. I read something this week, I don't remember the source, where the big banks have lost control of the spot price. Demand is pushing it up. In a time like this, the banks want the price it to be either volatile or declining, because they don't want people accumulating money in precious metals, because that's outside the banking system, and they can't charge you a fee for that. So have they lost control? That's what I read. So I don't know. When you put the markup on top, so the price is up $3,300, but the markup is up quite a bit. It was down below $1 not that far ago. $2.38 markup on top of the spot price, bringing it to $34.81 per round. And for 500, which is a monster box, 500 rounds, $17,405. Coming from my son, Preston, who is in the precious metal business. Thank you, Preston. Okay, that's it. If you have questions or comments, leave them in the comments section below. And if you want to give me a call, if you want to chat with me, feel free to do that. There's my email address and phone number. Thanks for watching.